This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial, where we provide you with holistic financial advice through Caleb Doane, their Vice President. Good morning, Caleb.
Good morning.
How's it going?
It's going well. How are you doing?
Good. Okay, so much to talk about.
Yeah.
I know that there's been a lot of buzz, especially coming from the president, regarding tax cuts, and he's applied the pressure. And so now we're trying to see what is actually going to happen. So what is happening with rate cuts?
Yeah. So we got some of the taxes all pushed through and everything. We got that signed into law. Now he really wants rates to be cut. And so he's talked a lot, about Jerome Powell lowering interest rates, and he's certainly been hesitant for a little while, wanted to keep things steady, but now there's been a lot of talk about lowering interest rates at the next Fed meeting, which is coming up here really soon. And so the likelihood, the market kind of has priced in that there will be a modest rate cut, and a lot of investors are just wondering how this is going to impact them. How do the rate cuts actually impact me in my everyday life? And a lot of that depends on whether you're a borrower or a lender.
Okay.
And a lot of people might not really realize it, but a lot of people fall into the lender camp. And so if you own CDs or you own bonds, you're actually lending money. If you have a CD, you're lending money to the bank and they're paying you the interest rate. And so if interest rates go down and that kind of trickles down through the rest of the economy, the rate that you're going to be able to get on CDs or bonds is likely to drop as well. And so if you're somebody who's getting interest from that, the question now is, how can I lock interest rates in while they're high before they get cut?
Okay, so how does this work? So let's start off with the average person. Like maybe you have a savings account, a money market account, maybe you have a 401k. Does rate cuts impact them at all?
Yeah, certainly. So like a money market account, for example, you might be getting 3% or something like that right now, maybe 4%. If interest rates go down, you're likely going to get less interest in that account there. So it impacts anytime.
So cuts is go down. So basically, you're going to be losing potential earnings on your savings account if the rate cuts go down. Okay, so why would the rate cuts go down? Like, what's the whole positioning, the stance that the president has versus Jerome's decision in this?
Yeah, so I mean, the Fed, who decides a lot of these rate cuts or not, it kind of has like a couple things that they're balancing. They want to keep inflation relatively low. They're targeting kind of that 2% annual rate, but they also want to make sure that the economy is doing well and that people are employed. And so if they cut rates, that typically stimulates the economy, but that could raise inflation a little bit. But then if they don't cut rates, that could kind of hurt the economy and maybe make unemployment go up. So they're weighing those two things. Right now, they think that inflation is starting to get a little bit more under control, and maybe there are some kind of warning signs in the economy, so it could be time to start cutting rates. Trump, of course, wants the economy to be stimulated. He wants the economy to do really well, and that's why he wants those rate cuts to come very soon, interest rates to be lower. It's easier for people to take out loans, start businesses, things like that.
Okay, so that's the impact for an individual. So if you have a savings account, okay, you may lose a little interest, but if you're seeking a loan, you can get, so does this apply to car loans, mortgages, credit card loans? You're just going to get a better interest rate?
Yeah, that's typically the case.
Okay.
So I mean, 5 years ago, you could have got a mortgage at 3 or 4% interest. Today, if you're getting a mortgage, it's going to be 6.5%, 7% interest. And so there's a lot of people, if you're not really on the lender side and you're more of a borrower, maybe you have a mortgage or home equity line of credit or whatever it might be. If you took out that mortgage within the past couple of years, as interest rates go down, you might have a good opportunity to refinance and get a lower interest rate. But at least us, kind of on the investment side, when we think about locking in the interest rates while they're high, one of the best tools that we've used for that is called a multi-year guaranteed annuity. And they act somewhat similar to CDs in that they have a fixed interest rate that they pay. But the nice benefit is that you get a lot more flexibility in how long you can lock it in for. So if you go to the bank right now and you say, hey, I want a CD, I want something that pays over 4%, you might only be able to get a 9-month CD or a 12-month CD. With a multi-year guaranteed annuity, you could lock in that higher interest for 5 years or for 7 years. And that way you're getting that high interest for that entire period of time, maybe when everyone else is getting a lower interest rate in the future.
Okay, so how do you feel that this really impacts the investor as far as, are they hoping like, yay, give us a tax cut, or they're like, no? And if it's no, should they activate some items right now before the before the rates get cut?
Yeah, I would say especially for conservative investors, if you have a lot of money in CDs or a lot of money in bonds, it's definitely time to act right now, because if interest rates get cut, now all of a sudden you're getting a lower interest rate on all of these financial investments that you have. That's going to hurt your bottom line. And so now could be a really great time to try to lock in those interest rates while they're high, maybe get something like a 5-year multi-year guaranteed annuity. What's going to be right for everyone, it's kind of individual based on your liquidity needs and your risk tolerance and all of that. So we meet with everyone individually to determine what's best for them.
Yeah.
But if you have a lot of money in CDs, a lot of money in a money market account, it's probably time to start taking a look at what's going to be the best thing to do with that, because rates are likely changing.
Okay, and when I keep saying tax, when rate cuts apply, is it a certain time of the year? Like, are we in prediction that it's going to happen? And if so, when would we see it roll out?
Yeah, so I mean, the Fed meets periodically. I think their next meeting is mid-September. So then they'll decide in that meeting if interest rates are going to be cut. And then you'll see that trickle down through the rest of the economy pretty quickly. Even, interest rates can even change ahead of the Fed changing rates, because they're just anticipating those things happening. So the Fed will start by lowering it a little bit. In all likelihood, they'll wait to see how it impacts inflation and the job market and everything, and then they can make tweaks as needed. But the general, consensus is that the anticipation is rates are dropping here pretty soon.
And when rates do drop, and it is mandated on the federal level, do all entities have to apply those rates? Like, for example, will you see your credit card rates go down, or is it like, well, we'll pick and choose? Like, will people see it across the board in all of their accounts and savings?
Yeah, so every like individual bank will be setting their own rates, and every individual credit card will be setting their own rates. But the rate that the Fed sets has such an impact across the rest of the economy that it generally changes things pretty significantly. Maybe not as much with credit cards, for example, but with mortgages, savings account, money market accounts, CDs, everything like that typically is impacted pretty significantly when the Fed cuts rates, because that's such kind of a pivotal interest rate that it impacts everything else across the economy.
Okay, and then final question for you. Does it impact people's retirement accounts, the 401ks and what they're saving up?
Yeah, absolutely. Because within 401ks, a lot of times people have bond funds and things like that. So the yield could certainly go down on the bond funds. So again, a big thing to keep in mind. That's why we look at 401ks. Maybe we can look at doing a rollover from a 401k into an IRA. We can look at locking in interest rates longer. If they're in an IRA, we have more investment options and more flexibility there. So every investor is a little bit different. Whether you're on the lending side or the borrowing side, most people have both. They have some CDs, some bonds, but maybe they have a mortgage too. So it's going to be a mixed bag for a lot of people. So now's a good time to take a look at your finances and see, do I need to make any tweaks here before rates get cut?
Okay, good stuff. Well, thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, now is the time to activate and to get in contact with them for their complimentary consultation to discuss all of this and more. We'll have their website and phone number listed below, and I'll see you after the break. This segment sponsored by Foster Financial.